going to be critical for the listeners to get how this works. So again, your point is that the credit union, they want to offer a variety of incentives for the executive to stay and working for them. So of course they pay him a salary and things like that. But in addition, they take a bunch of money up front. They effectively loan it to the executive, who then uses it to buy a high premium life insurance policy. And so you're saying that from the executive's point of view, that's not treated the same as taxable income because, hey, it's just a loan.
Exactly.
But then, of course, the executive gets a lot of benefits from that policy now being in place. But for the credit union's perspective, they know they're eventually getting their principal back plus some, a modest amount of interest, as you say, like maybe 2% or something annualized, because they effectively have like a lien against that life insurance policy, that when the death occurs and it pays out the death benefit, the credit union at that point gets paid back its original loan amount plus the accrued interest along the way.
Exactly. Yep. And it's a very unique tool, but it brings together what these institutions do best. We always say, credit unions are in the business of lending money. And so this is just an extension of that, right? They're able to retain their key talent by lending money. And yes, the benefit is created partially by that loan being at an exorbitantly low rate over a very long period of time. And so that right there is what has created the opportunity that we're taking advantage of through the Life Notes Trust. But in its inception, collateral assignment split dollar is, again, a loan from the institution to try to compete with some of those other parties that are putting in place, attractive retention packages such as banks and other for-profit entities. This is a way for them to get creative and retain a Steve Belergen, right? As opposed to him leaving and going to a bank down the street.